Okay, let's go on. This is our next session. Next section is about accounts and notes receivable. Liang has a question. Dividend belongs to equity? Yes. Dividends belongs to equity. Actually, dividend is you can call dividends a contra account to equity. Why? Because it reduces your equity. Yeah, it is a minus account actually. Yeah. So the higher the dividend is, the dividend payable, the lower is the equity, because it goes out of the company and to the shareholder. Yeah. So what are accounts receivable? What are accounts receivable? How would you, if you would describe an account receivable, how would you call it or write it? What is an account receivable? Okay, yeah, your money is mine. That makes sense to me. Or, yeah, and you take my goods away. Yeah, your money. Can also call it monetary claims against others. Yeah. Accounts receivable is your money. Give the car, don't get the money. Everything is correct. Yeah. And they are mainly acquired by selling goods or services. Yeah, mainly acquired by selling goods or service, or by lending money. Yeah, and there are accounts receivable, and there are notes receivable. Do you remember the difference? What is the difference between accounts receivable and notes receivable? Could you maybe describe the difference? Okay, Ray Chan says it's more formal. Yeah, it's more like a bank loan. Yeah, it's more formal. It has an interest on it. Yeah, typically it's longer. And an account receivable is more informal. Yeah, if you sell something, then you have an account receivable. Yeah, so this is more formal. With an interest, with an interest on it. Printed on. This is a real paper, like a bank loan. I think that is the best way to describe it. And accounts receivable. Oh, sorry. This is an example here for how a loan receivable, a note receivable, sorry, looks like. This is an example how a note receivable looks like. And here you have, for example, it says $50,000, Los Angeles, California, 6 months after date, Western Products promises to pay to the holder, Southern Company, $50,000 plus interest computed at the rate of 6% per annum. So this is how a note receivable looks like. Yeah, this is how a note receivable looks like. And here, for example, Western Product is called the debtor. Yeah, this is called the debtor. And Southern Company is called the creditor. Yeah, the creditor is the party, it's the creditor, who gets the money. And the debtor is the party who has to pay the money. Yeah. So this is debtor has to pay. Has to pay. And the creditor will receive. Receive the money. So this is a note receivable, and here you see the interest, yeah, 6% per annum. It's very similar to a bank loan, actually. Accounts receivable are typically classified as current assets. Yeah, because they are short term. Yeah, because current assets, because they are short term. Sometimes they are called trade receivables, and this is not because they are traded, but because they result from trading. They are a result from trading, trading goods, from selling goods, and the word trade is used to separate receivables from trading from non-trade receivables. Yeah, and for example, other receivables are non-trade receivables. Yeah, they do not result from selling products. Yeah, but mostly receivables result from trading products. Yeah, so. Okay. So these are the journal entries. The first journal entry is when a company sells something on account. Yeah, it's called on account. You can also call it on account receivable, or just on account. Yeah, you debit an account receivable and you credit sales revenue. Again, our accounting equation. Which elements are affected? Here. Can you tell me which elements are affected? What is an account receivable? Is it an asset? Is it equity? Is it liability? What is an account receivable? Asset, yeah, very good. Asset goes up. And sales revenue, what is sales revenue? Sales revenue is equity. Yeah, so equity, asset up, equity up. Accounting equation is in balance. Yeah, very good. So, and then our second journal entry, assets equal plus liabilities. Second journal entry. This is by the way, this is a different journal entry. This is a different case actually. Here, the company is lending money on a note receivable. So this company here is lending the money to another party. Note receivable, when you debit it, again, is an asset, goes up. Cash is an asset, yeah, it goes down. Yeah, asset up, asset down. Very good. So generally, when you're selling on credit, yeah, selling on credit means you do not only accept cash. It comes with a benefit, but it also comes with a cost. Yeah, the benefit is there are customers which prefer to buy on credit. They like it. And that's why you have additional sales and probably also have additional profit. Yeah. So these customers, they prefer to buy on credit. Maybe they do not have cash or they do not want to pay cash. And that's why your sales and profit increases. But it also comes with a cost. Yeah. Because actually maybe some firms, you sell some customers, you sell something on credit, they cannot pay. Yeah, and that's why you cannot collect from all customers. Yeah, so you cannot collect from all customers, and this comes with an expense. Yeah, this is a minus, and this expense is called bad debt expense. Yeah, that you cannot collect from all customers. Yeah, it's bad debt expense, also called someone have no money to pay my account receivable. Exactly, Ray. And this bad debt expense is also called uncollectible account expense or doubtful account expense. Yeah, it's also called. Yeah, it becomes that bad debt expense because someone is not able to pay the account receivable. Yeah, this is bad for you because then you do not get the money resulting from your account receivable. Yeah, so this is bad debt expense, or also called uncollectible account expense. Yeah, so this is the same. Yeah, but sometimes they call it doubtful account expense. So these are three words are the same for the same thing. Yeah, that some customers probably they cannot pay. Yeah. So provide bad debt to show it on the balance sheet. The firm has to set up an allowance. Yeah. And the allowance shows the amount of receivables the firm expects not to collect. Yeah. So the allowance is the total receivables accounts receivable the firm expects not to collect. Yeah, and here you see the allowance. Here, this is the allowance, and as you see here, this is on the balance sheet. Yeah, this is the asset side of the balance sheet. This is think about it as the balance sheet. This is the balance sheet, and here we have assets. Here we have the liabilities, and this is the allowance is a contra account. Yeah, so this is the contra account again. Contra account. Why is it a contra account? Because it has a minus. Yeah, see that? Yeah, it has a minus, so it's on the asset side of the balance sheet. On the asset side of the balance sheet, but it is not a normal account. Gross accounts receivable is a normal account, but allowance is it has a minus sign, so it's a contra account. So it reduces, actually, the higher your allowance is, the lower is your net accounts receivable. Yeah. So the higher the allowance, the lower your net accounts receivable. And the allowance is for taking into account that part of the accounts receivables will not be collected. Yeah, does that make sense to you? Is that clear? Does that make sense with the contra account? Okay. And you could, for example, to estimate the allowance, you could, for example, take customer credit information, or you could look at the days the receivable is outstanding, and the longer, the higher the allowance, or something like that. Yeah, but the allowance shows the total receivables a firm expects not to collect. Yeah. So firm expects not to collect. But you have to take into account, and you have to remember that allowance is not bad debt expense. Yeah, bad debt expense relates to new information. Yeah, and bad debt expense increases the allowance. Yeah, we will see the relation between the two, between bad debt expense and the allowance, on the next slide. Yeah. And here you see it. So generally, ending allowance is the allowance at the end of the year. Yeah, and to calculate ending allowance, you start with the beginning allowance of the year. Yeah, with the beginning allowance. Then you reduce, you subtract the write-offs. Yeah, this is when a customer cannot pay. When a customer cannot pay, when a customer goes bankrupt and cannot pay, for example, and you add the bad debt expense. So the bad debt expense increases the allowance. Increases the allowance. So this is the bad debt expense. This is new information. Yeah, you think, okay, I might have trouble with one customer getting the money. Yeah. So this is bad debt expense, and it increases your allowance. Yeah, but this relates to new information. When you have a write-off, the write-off actually it is merely a realization of what you expected to become true. Yeah. So what you have to remember, that the write-off has no effect on total assets, no effect on net receivables or on net income. And why is that the case? Because the write-off reduces both the gross accounts receivable and it reduces the allowance. Yeah. The write-off reduces both gross accounts receivable and the allowance. Yeah, and therefore the write-off has no effect on total assets. Yeah, or net receivables. Yeah. Yeah, because if you think about it, if you have a write-off and it reduces the allowance and it reduces gross accounts receivables, both are down. Yeah. You before thought that gross accounts receivable go down, and that's why you have created the allowance, and then when you write off, the account receivable, that's merely a realization of what you thought will become true. Yeah, so that's why if you have a minus here and you have a minus here, the net effect is 0. Yeah, Yeah, this is why you set up an allowance. You set up an allowance because you expect them, the customers, not to pay. Yeah, or at least not completely. Yeah, and when this becomes true, then you write the loan off, the account receivable off, and you also decrease your allowance. Yeah, and whenever you have new bad debt expense because you have a new customer that you expect maybe not to collect, then you increase your allowance by the bad debt expense. Yeah. Are there any questions? You can always ask me if there are any questions. Do not hesitate. Okay. So here we have the journal entries. And the first journal entry is when we account for bad debt expense. So this is when we realize that one specific customer, maybe we sell something to, will probably have problems to pay. Yeah. So here we account for bad debt expense. We debit bad debt expense and we credit allowance for doubtful receivables. We debit bad debt expense and we credit the allowance. So how is our accounting equation affected? In this case, asset, okay, allowance is an asset. And that means actually the assets go down because the allowance goes up. And bad debt expense, what is an expense? Where does expense go into? Equity, exactly. Yeah, so equity is down and assets is down. Yeah, accounting equation is in balance. Very good. Very good. Okay, and now later we find out that actually the customer for which we set up the allowance cannot pay, or actually we realized that what we expected to become true actually became true. Yeah, and this is the second journal entry. We write off the account receivable. So, and here our accounting equation. And it doesn't really matter, because because the allowance goes down and accounts receivable also goes down. So essentially you can say there is no effect. Yeah, allowance goes down and accounts receivable, which is gross accounts receivable, also goes down. Yeah, so allowance goes down and gross accounts receivable goes down. There's no effect. Look at it here. Look at this. Gross accounts receivable goes down. Allowance goes down. Zero effect. Yeah? Does it make sense? Or are there any questions? Why it's zero? Because actually the minus in gross accounts receivable is exactly as high as the minus in the allowance. So if you let's say call it minus 10, and you have minus 10 here as well, yeah, then it's zero. Yeah. So this second journal entry, basically you do this when you realize that a customer for which you thought that he will not pay actually cannot pay because he goes bankrupt. Yeah, and then you say, okay, I have to write off my account receivable, but the good thing is I have already taken that into account by my allowance, and that's why my allowance can also go down, and my net effect is zero. Yeah, you have the negative effect you have already before. Yeah, when you book bad debt expense. Yeah. So, and here it is just a realization of what you thought will become true, and then it becomes true, and it's not negative anymore because you already expected it, and that's why you increased your allowance, basically. Creditor is the party to whom the money is owed. Debtor is the party that borrows the money. The creditor, by the way, the creditor has an account receivable. As an account receivable. What does the debtor has? On his balance sheet, there's no account receivable, but an account. Think about it. What is the opposite to an account receivable? The creditor has an asset because account payable. Yeah, very good. The debtor has an account payable on the balance sheet. And the creditor has an account receivable on the balance sheet. There's one thing some companies do, and they do factoring. Factoring means you are selling accounts receivable in order to speed up cash flow, yeah, to become the money earlier. Yeah, in order to speed up the cash flow, you are selling accounts receivable. This is what factoring is. Selling accounts receivable. But it's quite expensive. It's about 5% of the face amount. Therefore, most firms do not use it. Yeah, especially the firms which have other options. They do not use this factoring, but instead they borrow from banks, for example. Yeah, and they only do factoring when they desperately need the money. Yeah, when it's most often it's bad firms that cannot pay. Yeah, they use factoring. This is how you account for factoring. When you're selling your accounts receivable, so cash is an asset. Cash goes up. Yeah, your account receivable goes down. Yeah, but it goes down even more. Yeah, it goes down more than cash because you do not get so much cash, and you have a financing expense. Yeah, which is the difference between the two. Yeah, asset 2, and the expense decreases your equity. Yeah, exactly. So this is factoring. This is journal entry for factoring. Cash goes up because you get cash by selling your accounts receivable. Yeah, but you do not get as much as the account receivable is the book value of the account receivable, and the difference is an expense. You have several ratios that are related to accounts receivable. One is receivable turnover, and the other is collection period. Receivable turnover is calculated by dividing sales by average receivables. Yeah, sales divided by average receivables, and essentially it shows the number of times the average receivables are converted into cash. Number of times receivables, average receivables are converted into cash. Yeah, and the collection period is actually the other way around. You divide 365, which is the number of days of you have within a year, by the receivable turnover, and then you get what is called days sales outstanding. So the longer days sales outstanding are, the longer it takes for an average customer to pay the bills. Yeah, so here days sales outstanding, the collection period, the shorter the better. Yeah, the shorter the better, because shorter means cash is coming in more quickly. Yeah, cash is coming in more quickly, and that's what you want as a company. Yeah, you want receivables to be turned over as fast as possible. Yeah, and if it's more days, then it means that customers may have a problem with paying. Yeah. With receivable turnover, you want a high turnover. Yeah, you want that to be high, because it means that your receivables, your accounts receivable are turned over quite often during a year. Yeah, because sales are much higher than average receivables. Within the collection periods, it's the other way around. You want this to be low. Yeah, because that means that that customers are paying fast. Yeah, it doesn't take long for a typical customer to pay your bills. Yeah, and then we have another ratio which is called the current ratio, and this is current assets divided by current liabilities. Yeah, current assets include accounts receivable, inventory, and current liabilities. You also know what is current liabilities, or everything which is short term. Yeah, and you want, when you're calculating the current ratio, you want it to be high. Yeah, you want it to be high, because that means when you can, I mean, when you turn your current assets into cash, you can take that cash to pay off your current liabilities. Yeah, so it should be high. Maybe it shouldn't be too high, because if it's too high, that means too much money is invested into current assets. Yeah, and that's also, you do not want that either. Yeah, you want it to be high, but not too high, actually. Yeah. We will have we will make exercises, and then you will have to calculate those ratios. So do you have an idea how could you extend credit to only to credit-worthy customers. What could be a plan to do this? What could be a plan to do this? Credit evaluation, very good. Yeah, you could do credit checks. Exactly. And how could you maximize your cash flows and providing credit services by grades? Exactly, that's the way you do it. How could you maximize? How could you maximize your cash flow to customers? What about that? You could, for example, send and second and third statements to the customers. Yeah. So how to extend credit only to run credit checks? Yeah, run credit checks. And how to maximize cash flows? Send second and certain statements to the customers. Yeah. To the customers that are not, or short credit period of accounts receivable. You could also, yeah, you could maybe you could also shorten the credit period. Yeah, very good. Also very good suggestion. Yeah, it's also possible. Yeah. Okay. Maybe, yeah. Okay, I think for today, you've done a great job. Thanks a lot. Good work. And the next session is tomorrow. My timetable says tomorrow at 12:30 German time. Yeah. So tomorrow 12:30 German time. See you tomorrow.